Everyone, so today I'm going to talk about Internaxx and I'm going to compare it to another platform which is used a lot, which is Saxo Bank. Now, what are the positives and negatives of each one? Now, first of all, I would say in terms of investment choice, they both have a lot of choice. They both have a lot of good investments held within them, but so do almost any other platform in the world. So don't get confused by that. I remember the late and great Jack Bogle from Vanguard said, choice is an enemy of investors. So a lot of people think, oh, wow, that's got 10,000 funds compared to 2,000 funds. But the point is you don't need all those funds. You just need a small selection of good funds. So in that regard, they're both as good as each other. They both have some good low-cost options for investors. However, I would say one of the biggest differences is that for larger accounts, Internaxx are cheaper, but for smaller accounts, they're more expensive. Now, why is that? Basically, Internaxx charge flat fees. Now, it depends on many things how much they charge, but basically, typically, most people pay $200 or $300 per year, depending on how much they trade on the platform. So that means that on larger accounts, that's a very good deal. But let's say you're just starting investing and you've got $3,000, $5,000. That could be 10% or so of your portfolio. That's too expensive, right? Whereas Internaxx, they charge percentage fees. And that means that on bigger accounts, they're much more expensive than Internaxx. But on smaller accounts, they're much cheaper. So what's the better platform will depend on basically how much money you've got or how much money you're willing to spend or put on the platform. But also it depends on other things. Like it depends on things like location. So I'll give you an example. Internaxx couldn't used to accept for Japan, but last year they can accept for Japan. So depending on where you live now and depending on your nationality, if you're American, Australian, whatever, sometimes they can accept, sometimes they can't accept. So that will also factor into their consideration. In terms of the online platforms, I'd say they're fairly similar. So what I would say is, in general, don't care too much about the platform. A lot of people get into what I call analysis paralysis. They'll spend months comparing different platforms, but the key thing that is important is this. Fees are important, and also what investments you choose. If you have platform A and platform B, even if platform A is more expensive than platform B, but on platform A you're in some good investments and platform B you're in bad investments, you're going to make more money on platform A. So never forget that. The platform you use is never as important as the investment decisions that you make. And that leads me on to the final question or the final comment for today. And that's that the evidence shows that the average DIY investor only gets about 4% a year when the stock markets average 10% a year. Now, why is that? The average investor speculates. The average investor is egotistical. The average investor is maybe fearful. Just think of some of your friends during the financial crisis or during Trump's election. Many people panicked. So the people who use these platforms the best are the people who buy, hold, and forget. The less you trade, the more you make. But the more you trade, the more you analyze, the more you panic, all those things will contribute long-term to lower returns, not higher returns. So always remember, some of the things like 24/7 online access, that's actually not a great thing for some people. A lot of people out there should literally never check their valuation. Buy, hold, and forget. And if you can do that, you will beat 95% of other investors. Okay, everyone, I hope that was useful, and get in contact with us if you have any questions on the email.